Hello my fellow freedom builders and welcome back to the channel. This is a small educational video about how to find out how much upside potential there is in a stock that you're considering buying or that you have in your portfolio already. So normally when we talk about and we hear analysts and estimates talking about the targets for a stock, they have all sorts of complicated math, almost a bit like what you see on this slide here. And it can seem like a complete magical task to figure out how much could a stock actually go up in price. But maybe it doesn't have to be that complicated at all, and that is what I'm gonna have a look at today. Now, when you look at all of these different valuations tools, I know this is a bit blurry, but there are a ton of them trying to figure out what is a fair value of a stock. The point, of course, being that if a fair value is $100 and you can see the stock right now is trading at $50, then you consider it probable that the stock could go up to 100 in price, and then you have made 100%. Now there are a ton of these: Peter Lynch valuation method, Graham number, projected free cash flow, all sorts of discounted cash flow, and so on and so forth. And as you can see, a fair price in a stock like this one I just picked randomly is somewhere between $6.43 and $88.59. Now that is not very precise, and these are even some very esteemed strategies to figure out a fair value. They just have a completely different set of inputs. So instead of relying on all these very different strategies with their complicated math, we will actually go for something a bit simpler. Now what you need is basically just two things. You need EPS, which means earnings per share, and you need PE, which is price earning. Now, what do these two mean? Earnings per share is basically a company making some money, and the earnings, when divided out on each of the shares, that gives you the earnings per share. The price earning is the price, the number of dollars an investor is willing to pay for each dollar earning. Now, if a company creates a profit of $10 per share, meaning that the earnings per share is $10, and the investors are willing to pay a PE of 20, meaning that for each and every dollar in profit, you will pay $20 in price. That gives you 10 times 20, gives you 200. That is the price of the stock. Now, let's say next year that the profit of the company, due to good management or a favorable market, the earnings per share goes up from $10 to $15. If the investors are still willing to pay a price earning at 20, you still multiply these two and say, all right, the profit now, if you were to buy the stock now, would be $15, still multiplied by 20, that gives 300. So if the price earning is the same from one year to another, and the profit goes up by 50%, then the price go up by 50%. Now there could be some reasons why investors would be willing to pay a smaller price earning, but if the profit still goes up from $10 to $15, but the price earning drops from 20 to 10, well, then the stock drops from a price of 200 to a price of 150. Now, why would the investors be willing to pay a smaller price earning? Well, that can be a million different reasons. It could be that the first year the investors thought there would be a fantastic growth in the company, and therefore they were willing to pay a higher price earning, but now they are starting to doubt the growth rate a bit, so they are saying, well, there's a bit more risk in the company now, so if I should buy this, I'll not pay as much for each dollar profit because I'm not as certain of the future as I was a year ago. It could also be that, for instance, interest rate goes up in society. We have for a number of years had interest rates around 0%, and now they are up at, let's say, 5%. That means that the investors could go out and have a risk-free investment in some bonds, government bonds, getting 5%. So why would they put their money into a risky company where they don't know what the future will be and only get 5%? And 5% equals actually a price earning of 20. That is 100 divided by 20 gives you 5%. Now down here, if you invest at a price earning of 10, you are actually, if the company continues to produce its profit, getting 10% in yield on your money. So down here, the investors might have thought of the company as being a bit more risky, and therefore they want a higher yield because there is a higher risk involved. So there can be many reasons for this, but it's a good point, and a point that many investors forget, that they only look at the profit and they're thinking to themselves, okay, 50% increase in profit, that must be good. Well, not if the overall investors market think that they will pay a lower price earning. I'll give you a live example just in a second. There we go. Here we have Target Corporation, a big consumer defensive stock in the United States in the food and tobacco industry group. And as we can see here, it's a fairly solid company, good quality, good value. All this stuff that we can find in MyStockScanner here. We can see that there are some good return on capital and equity, and overall it's a decent company. Now, the price earning on an annual basis, meaning that the last yearly earnings report, we could see that there was a 24.5 in price earning, meaning investors were willing to pay $24.50 for each dollar profit. Now, on last 12 months, meaning that we are looking at the quarterly earnings reports there, that would only be 18.6, so it has been dropping a bit. So it is somewhere between 18 and 24, that is the number we will be looking at. We can see that the earnings per share growth it was actually negative in 23, but expected in 24 to be positive, and again in 25. So I'll not dive into the reasons for that there, but you can see that overall in years and years here, they've had some decent earnings per share growth, and then one bad year in 23. But let's go into the valuation chart and have a look at this. Because when we're looking at this, we can see that there are the latest, that was the drop in earnings. We can see that they are suspected to make a good growth here in 2024, some in 2025. And if we go out just another year, we can add another 10% just for the sake of it. All right. Then let's put 24 in as a price earning. That was the number we had in the last annualized number. Now, if these growth numbers are correct, and that is fairly easy to calculate these numbers out in time, we're just taking the earnings per share now, and then we are growing it by the rate that we are putting in. Now, no one knows if the earnings will actually grow by these numbers, so this is not a magic method that can give you the exact number or exact price of the stock in the future. The numbers, of course, need to be correct, but let's play around with them in a second. So if these growth numbers are correct, and if investors are willing to pay $24 for each dollar profit, then it's fairly easy to calculate what will the price be out here in 3 years' time. That will be roughly $265, and today the price is $149 for $150 here. So you will get a price increase of 81.1%. Now that is not too bad, especially not for a big consumer defensive stock like Target. But what do we know about the future? Well, not much actually. Let's try and bump the growth down and say, what if they actually in the later part of this period are ending up with 0 in profit growth? Well, then we get 49.7%. But what if we keep the 10% here, but start to bump down the price earning? What if something happens in society? Maybe we get a rate cut and all of a sudden we have low interest rates again, and all the money that would be put in stocks are put into Nvidia and AI stocks and all this high-tech stuff, and they are flowing away from the defensive consumer stocks up here. Well, if that happens, well, then the price earning might drop. Let's say it drops from 24 to 18. These were the numbers we were looking at just in a second. And as you can see, the rise in price now goes down from 81.1 to 35.9, meaning that the price will only end at 200. What if it drops even further? What if it drops to 12? I don't think that is reasonable to think, but if it were to drop to 12, even though they had some very good growth numbers here, then at a price earning of only 12, we would see Target dropping over the next 3 years by almost 8%. So that is where private and new investors sometimes get confused, because they are thinking to themselves, why on earth is this stock price dropping when they are making record earnings? Well, that is because that here there were a certain growth numbers priced in, and investors were willing at the given point in time to pay a high price earning. If this drops, then we see a drop in future prices. So again, this is not a magic method. This is not something where you can say exactly where the price will end. But if you're looking towards the analysts and they have a reasonable picture of where the stock is going, and often they do, they actually have a decent idea of how much it'll grow. It might be by 10% or 12 or 8 or 7, but it is often in that range, especially with the larger companies where analysts, there are a large number of analysts actually knowing a lot about the company. So if they are saying 10%, it probably doesn't get to be minus 10%. Of course it can be, but it is not as likely. The big factor here, the big variable that really can change future prices is the future price earning. And we have no idea where this will be going. So therefore, when I'm looking at a stock, I like to put down the growth rate and say, okay, what if they almost don't have any growth? And then again say 18 is the number we had before. What if that actually becomes a bit lower? Do I still have a reasonable investment case? And well, you could say minus 0.2% is not nice over 3 years. No, but it's also not losing money. So therefore, Target could be a reasonable investment seen from this perspective. But just remember that the future price will always be earnings per share in the future times the price earning investors are willing to pay. Thinking of this make the future pricing a lot simpler, and you can actually often get a lot closer to the correct price and out in time than many of the analysts using their very, very complex pricing models. That is my experience anyway. I hope this made sense. Otherwise, please feel free to comment in the comment section below. If there are some questions, I'll do my best to answer them. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye for now.